As we approach 2025, economic indicators suggest a favorable environment for dividend-paying equity funds like the Schwab U.S. Dividend Equity ETF or SCHD. Lower interest rates are expected to dominate the financial landscape, creating a catalyst for SCHD's growth. This video is going to explore why lower interest rates will likely drive a huge surge in SCHD's performance, highlighting key economic factors, investor behavior, and the ETF's unique qualities that position it for success. Welcome back to the Financial Freedom Show. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest in future videos from my channel. If you enjoy my videos and want to have your name featured at the end of every video or join my private Discord server, please be sure to check the link in the description down below and join our channel. And without further ado, let's get into today's video. So interest rates play a huge role in shaping the investment trends of both ETFs and individual stocks. When interest rates are high, fixed income securities such as bonds and savings accounts become more attractive alternatives to dividend-paying stocks. Investors flock to these instruments for the relatively low risk and predictable returns. However, when interest rates fall, the yield on bonds diminishes, making dividend-paying stocks more appealing. SCHD, which focuses on high-quality dividend-paying companies, stands to benefit from this shift. With lower rates, investors seeking income will likely gravitate towards dividend ETFs, as they offer higher yields and the potential for capital appreciation. Historical data has consistently shown that periods of declining interest rates often coincide with increased inflows into dividend-focused funds. The Federal Reserve's monetary policy trajectory is a key determinant of future interest rates. By 2025, the Fed is expected to pivot towards rate cuts to stimulate economic growth and counteract any lingering recessionary pressures from the previous tightening cycle. This environment will likely usher in a prolonged period of lower borrowing costs and reduced yields on traditional savings investments. Lower interest rates also bolster corporate earnings by reducing borrowing costs for companies. Many of the high-quality firms within SCHD's portfolio, such as Coca-Cola, Verizon, or Johnson & Johnson, are well positioned to capitalize on this trend. As these companies experience improved profitability, their ability to sustain and grow dividends strengthens, further enhancing SCHD's appeal to investors. So, what is SCHD? SCHD is the Schwab U.S. Dividend Equity ETF, which is a popular exchange-traded fund that focuses on high-quality U.S. companies with a strong history of paying dividends. It is designed for income-focused investors who want to benefit from both dividend income and capital appreciation. There's a few features that SCHD is well known for. The first one is its dividend yield. SCHD seeks to provide a high dividend yield by investing in companies that consistently pay dividends. This fund generally targets companies with a high dividend yield and a track record of stable or growing payouts. It also has a good investment strategy. SCHD follows a passively managed index-based strategy. It tracks the Dow Jones U.S. Dividend 100 Index, which includes 100 of the high dividend-yielding stocks in the U.S. To qualify, companies must meet certain criteria, including a history of paying dividends and strong financial health. The top sectors in SCHD primarily invest in sectors like information technology, consumer discretionary, and healthcare, while focusing on large cap companies with established market positions and sustainable dividend payments. The expense ratio of SCHD is one of its most attractive features, with its low expense ratio of just 0.06%. This makes it an efficient option for long-term investors who want to minimize costs while benefiting from dividends. It also has a good performance track record. Historically, SCHD has performed well in both bullish and bearish market conditions. Its focus on dividend-paying companies helps provide income even in periods of market volatility. It also has good dividend growth. SCHD's underlying holdings are selected for their potential for dividend growth, making it appealing to investors looking for both current income and long-term wealth building through reinvested dividends. So why would you want to invest in SCHD? The first reason is steady income. If you're an income-focused investor, SCHD provides quarterly dividends, making it a solid choice for generating passive income. It's also tax efficient. As an ETF, SCHD offers tax efficiency compared to mutual funds due to its structure, which allows for fewer capital gains distributions. It also has a low expense ratio, like we said earlier. It has an expense ratio of just 0.06. SCHD is a very cost-effective way to gain exposure to high-quality dividend stocks. Its capital appreciation potential. While primarily a dividend fund, SCHD also has exposure to growth potential, as many of its holdings are in strong growing companies. So SCHD is an excellent choice for investors who are looking for both a combination of income and growth, with a focus on stable dividend-paying companies. It offers low costs, strong performance, and tax efficiency, making it a strong contender in the ETF category for dividends. If you are looking for a way to build wealth through dividends, SCHD could be an ideal option for your portfolio. SCHD is also uniquely equipped to thrive in a low-rate environment due to its strategic focus on high-yielding and financially robust companies. Its methodology emphasizes metrics like dividend growth, return on equity, and free cash flow, which are key indicators of a company's ability to maintain consistent dividend payments. This rigorous selection process ensures that SCHD's portfolio remains resilient even in volatile market conditions. Another critical advantage in SCHD's low expense ratio of 0.06 provides cost-efficient exposure to dividend-paying equities. In an era of lower rates, investors will prioritize funds that maximize returns without eroding their gains through excessive fees. SCHD's cost efficiency, combined with its historical performance, makes it an attractive choice for income-focused investors. Behavioral finance also plays a significant role in SCHD's potential surge in 2025. Lower interest rates often lead to increased demand for equities as investors seek better returns in the stock market. Dividend ETFs like SCHD provide a balanced solution, offering both steady income and exposure to potential market upside. This dual benefit is especially attractive to retirees and conservative investors who are reluctant to take on excessive risk. Moreover, as rates decline, the relative attractiveness of SCHD's dividend yield compared to fixed investments grows. This yield differential can drive significant capital inflows, boosting SCHD's price and liquidity. Combined with a growing trend towards passive investing, SCHD's reputation as a reliable income-generating vehicle will likely attract both institutional and retail investors. In conclusion, the anticipated lower interest rates in 2025 create a perfect storm for SCHD's growth next year. By offering high-quality dividend exposure, cost efficiency, and resilience, SCHD is poised to attract significant investor interest in a low-rate environment. As fixed income yields dwindle and equity markets gain momentum, SCHD's blend of income and growth potential will make it a standout performer. Investors seeking to capitalize on this trend should consider SCHD as a cornerstone of their portfolios in the years ahead. Hope you enjoyed today's video. If you did, please be sure to hit the like button and comment down below if you're adding SCHD to your portfolio. I'd love to hear from you. And we'll see you in the next one. Thanks for watching.